I promised it in the first video, and today I'm here to deliver. Let's talk divergences. First, let's identify market structure by marking out our highs and lows. Specifically, we're looking for trends which are defined by sequences of higher highs with higher lows or lower lows with lower highs. Understanding market structure is essential because divergences work in conjunction with price action. A divergence occurs when price and a momentum oscillator like the RSI print consecutive highs or lows in conflicting directions. This signals a potential shift in momentum. To identify divergences, we mark up the highs and lows on price, then mark up those same highs and lows on the oscillator. It can help to draw a vertical line on your chart to properly line up price with the oscillator, and Alt plus V is a good shortcut for that. Now, look for instances where price makes a new high or low, but the oscillator fails to confirm that movement. This discrepancy can indicate a potential reversal, pullback, or even continuation depending on the context. To more easily identify the divergence, let's draw lines connecting the bodies of the candles and the highs and the lows of the RSI. I will say that yes, there are indicators in TradingView that will do all this drawing for you, including the stock RSI tool, but with that being said, I've yet to find one that is both accurate and fast enough at printing to get in on the move that it's signaling. Divergences are a concept worth learning to perform manually if you're interested in them. That being said, we connect the bodies of the candles as opposed to the wicks because oscillators print based off of the close price of any given candle, not its extremes. Now that we're all marked up, I want to point out that there's two main types of divergences that you should be aware of: regular and hidden. If you're the type of trader who's only ever looking to trade reversals, then you're just looking for regular divergences. In an already existing uptrend, you'd be looking at the highs formed by price and the RSI. When price forms a higher high but the RSI forms a lower high, that is a regular bearish divergence and it's a sign for a potential correction. Once again, a correction can come in the form of a full-blown reversal or just a small pullback. So how do we stay out of the pullbacks and focus on targeting reversals? That's where the additional context and confluences come in. Do not look to trade every regular divergence you find. Instead, only consider regular divergences that form in key areas of support and resistance, supply and demand, or even the previous day's high and low. A trade idea for utilizing regular divergences for reversals could look like this: identify a trending market, anticipate and mark up a location for a potential reversal, identify a divergence as it's forming in the point of interest, then enter using price action patterns such as an engulfing candle or a pin bar. If you're a continuation trader, you have a few more options. First, let's talk about hidden divergences. When looking for continuation in an already existing uptrend, you're instead looking at the lows formed by price and your oscillator. When price makes higher lows, but the oscillator makes a lower low, this is called a hidden bullish divergence and a sign of a potential continuation. Just like regular divergences, hidden divergences are a confluence, not an entry trigger. If you're looking for continuation, consider this for your trade idea. First, identify a trending market. Then, during a pullback, identify a divergence between the pullback and the previous market structure. Then you can enter using price action patterns such as an engulfing candle or a pin bar. Entering before some sort of confirmation through price action is risky, as price could continue to fall and match the oscillator's lower high. There is a use case for regular divergences for trend continuation, and on a personal note, these are actually my favorite form of divergence. During an extended or complex pullback, you'll often find price making intermediary highs and lows before resuming the trend. Oftentimes, price will form a regular divergence to signal the end of the pullback. As you can see, we have divergence as the RSI made a higher low. Here are some final quick tips for getting more consistency out of your divergences. If the line that you're drawing to connect highs or lows on price or your oscillator go through said price or oscillator like this, then the divergence is invalid. If it seems like multiple divergences are occurring at the same time, take a moment to assess the context. You almost always want to only concern yourself with the most recent one. Bullish divergence occurs on the lows and leads into long entries. Bearish divergences occur on the highs and lead into short entries. Don't use divergences as a foil to your existing trade plan. I see far too often people say, I was long, but I saw a bearish divergence, so I got out of the trade. Divergences occur everywhere, especially on lower timeframes, and most regular divergences are only signaling pullbacks. Lastly, divergences need context. Remember, they're a confluence for a trade plan. They are not the entry trigger.